Well, good morning, everybody. My name is Andrew Sallway. Welcome to the first of 7 webinars to be held over the summer months for our banking and financial services clients. We've had just under 100 people register for today's webinar, ranging from relationship managers to credit officers and restructuring and workout managers from right across the country, and from big banks, regional banks, non-bank lenders and fintechs. So welcome, everyone. In the coming weeks, we'll have webinars where we will discuss the assessment of solvency, the impact of administrations on financiers. We'll have a guide to IA's business reviews and pre-lends. We'll do a session on tax issues in insolvency. We'll talk about the priority regime in insolvencies and how they impact returns to financiers. And we'll also finish up with a review. By that stage, it'll be a review, can you believe it, of 12 months of living in a COVID-19 world. Just some homework, or some housekeeping, I should say, as the slide comes across. If you have any questions today, you'll see on the right-hand side of your screen, there is a questions pane. We will respond to questions via email, all questions via email after the session concludes, and we'll try and respond to as many questions as we can during the presentation. We'll also have time for questions at the end. Slides will also be made available to you after today's session. If you have any technical difficulties at the moment or during the session, you can see on the right-hand side there's an access support button, a little eye there. So you can click on that, or you can go to that web address there, support.goto.com/webinar. And after the session, we'll send you a link to the slides, an email, a link to the recorded session, and which will also have access to past and future webinars. So our presenters today, I'll just throw to each person individually to introduce themselves. But Will Sinclair, good morning, Will, how are you?
Good morning, Andrew, I'm very well.
Like to introduce yourself?
Just to introduce myself. Yeah, no problem at all. So my name's Will Sinclair. I'm a partner in our business services division here in Sydney. And typically what we do is we work with a really broad client base of SME clients broadly, or high net wealth individuals, family groups, that sort of thing. And typically we provide a really broad range of tax and advisory services. But obviously the last 6 to 8 months or so, a lot of our energy has been spent advising on the stimulus and support measures, particularly obviously JobKeeper. So that's primarily what I'm going to be talking about today, and I'm delighted to be here. Thanks.
Thanks, Will. Up to Brisbane. Good morning, Andrew Fielding.
Good morning, Andrew. Good morning, all. Yes, I'm a partner in the Brisbane office in the business restructuring team. We've got a reasonably large team of about 25 people here, and still working with a lot of our clients at the moment to help them through this COVID environment.
Thank you, Andrew. And good morning to Nick down in Melbourne. How are you, Nick?
Andrew, I'm feeling on the cusp of liberation. So looking forward to the month end when we can more properly return to the office in some way, shape or form. But I sit in the restructuring team and in the Melbourne office.
Thank you, Nick. And for those of you that don't know me, Andrew Sallway, I'm a partner in the business restructuring team as well in the Sydney office. And together with Duncan Clubb, we have a team of 15 people doing restructuring, turnaround and insolvency work. So what we'll cover today, there are 4 key areas. We'll start by talking about deferrals, relief, JobKeeper and insolvent trading moratoriums, the protections that are out there at the moment. We'll discuss the new proposed insolvency laws that are coming in from the 1st of January. We'll talk about learnings from key stakeholder groups, things that we've learned from clients and referrers during the current pandemic. And we'll conclude by talking about some of the restructuring strategies that we think will be prevalent in 2021. So let's get started. We'll start off by talking about some of the government's efforts to support businesses during the pandemic, and I'll hand over to Will Sinclair.
Yeah, thanks a lot, Andrew. So I should say it's certainly not my intention to talk about any technical aspects of any of the government stimulus or support measures. I really just want to have a bit of a chat today about like the practical experience of our clients through this period, and particularly the ongoing experience, given that for a large number of our clients, particularly here in Sydney, I think possibly that the guys in Melbourne might have a slightly different experience, but for a large number of our clients, a lot of the support measures are coming to an end. In fact, a lot of them will be coming to an end for clients today. Today is the due date for the lodgement of the September BAS. So for many companies, that they will be receiving literally the last of the government support effectively today. So obviously it creates some new challenges for clients, for small businesses, sort of moving out of the COVID phase, notwithstanding that things are starting to open up again. So this first slide was meant to be a bit of a summary of what is ending in terms of the stimulus and support measures and what is going to continue and be ongoing. And I have to admit, I was a little bit surprised when I put it together, because it sort of gives the impression that there might be more ongoing support than there is ending, but that's certainly not our experience. I think that most of the really significant measures for most Australian companies are coming to an end. And in particular, the first one we mentioned there, of course, our beloved friend there, the JobKeeper program or the JobKeeper scheme. So the first phase of that came to an end effectively sort of last month in September. 28th of September was when it ended. The program has been extended through until the end of March, but and I do have a slide to give a little bit more background about this, but our experience is that it is much more difficult for clients, for most Australian companies, to access the extension of JobKeeper than it was to get into the first phase. And primarily that's because, one, the test periods have changed, two, the nature of the revenue turnover test has changed, and thirdly, the nature of the definition of turnover has changed. And I think looking back a couple of months, I think the government was estimating that they were going to spend about $106 billion on JobKeeper, but only about $16 billion of that was meant to come into the extension, or JobKeeper 2.0, which would indicate that somewhere around sort of 15% of the total cost would come in the extension, which I think gives some indication of how many businesses will fall out of it. Although I think those numbers may need to be revised now, given what's happened in Melbourne. I haven't seen any updated numbers. In terms of the other things that are ending, I spoke a little bit about the small business cash flow boost. That was the payments of up to $100,000 to businesses, which was delivered through the BAS. That is now over. The HCO and assistance and support is a really interesting one, and you'll see I've put a question mark there. So one of the things the Tax Office did at the beginning of the COVID period was that they indicated that they were willing to work with businesses to provide payment arrangements, extensions of time to pay, interest-free periods, so effectively interest-free loans to businesses to pay debts due on their BAS and their tax return. Important to note, it didn't apply at all to superannuation. That still had to be paid. And there was an indication that this would effectively sort of go through until the end of the initial phase of JobKeeper. And we did find that the government, the HCO, was extremely generous in terms of the payment arrangements that it was offering to businesses. Some of them were quite astounding, payment arrangements over 12 months. We negotiated one over 24 months, 24 months interest-free debt. It's a pretty compelling offer to be able to roll a client into. But the indication was that wouldn't go on forever, and that would start to come to an end, and that we would go into a phase where we were going to have to negotiate with the Tax Office again to get payment arrangements. The question mark is there because that hasn't been our experience so far. The HCO has still been very willing to work with businesses, so it'll be interesting to see what happens there. And of course, the early release of superannuation comes to an end on the 31st of December as well. So I'd suggest that the people who are going to access their superannuation have done so, and hopefully that won't be available again. It's been a little bit controversial. And then in terms of the ongoing support, obviously JobKeeper 2.0 is much less available, I think. The instant asset write-off and accelerated depreciation, we're not seeing a huge take-up of that. That is purely an accelerated tax deduction. I don't think it's a particularly compelling prospect for a lot of companies, for a lot of clients, to get them out there investing. State-based support, I can't talk too much about, because obviously I think this is a national session, so that's different in each state. But I know in New South Wales, again, we've been able to negotiate payment arrangements for payroll tax, which has been very useful. I know that in Queensland and Victoria, they're offering some deferrals and some rebates there. So still a bit happening at a state level. The commercial rent relief thing is obviously still ongoing, particularly for businesses that stay in JobKeeper. And then I'm going to talk a little bit about the additional federal budget measures. But I think the key point from this slide is that for a lot of businesses, and it's certainly our experience, is that as of right now, the vast majority of the government's initial stimulus and support measures are coming to an end. And I think that's the reality that a lot of businesses are facing. Something that will be an ongoing challenge for them, I think. Mike, I should have moved to the next slide if we could, Andrew.
Yes.
Which I'm going to skip over. Thanks for that. I'm going to skip over this one really quickly because I promised I wouldn't talk about the technical side of JobKeeper, but just wanted to sort of show that, yeah, it is effectively being phased out. The rate is reducing, but the key point is that it is getting much more difficult to access. We're finding that most clients haven't been able to access it. And so for many Australian businesses for whom JobKeeper has been a real lifesaver, it's been a fantastic measure for them. They now have to face the commercial reality that it's over. They won't be coming back. I might get you to keep moving there, Andrew.
Yep, there it goes.
Thanks for that, mate. So obviously the additional federal budget measures, obviously there's been some stuff here as well that's been targeted in terms of helping businesses to get through the COVID period. And I should mention as well, I haven't mentioned here any of the state-based measures, again, which have been quite interesting in terms of helping businesses out. I know in Sydney, the Premier's giving us all $100 each to go to the pub, so that'll be pretty good. I think that's a pretty popular measure. We'll be taking advantage of that. But in terms of the federal budget measures here, particularly the ones that are targeted at businesses, the JobMaker scheme was probably one of the key ones. Obviously, the little brother. So we now have JobKeeper, the JobMaker, and JobSeeker. JobMaker's the third, the little brother in that, which again is aimed at trying to get businesses to hire new staff, to get them off welfare effectively, and particularly targeted at young staff. And again, the implementation of this has actually been reasonably complex. And again, we're not seeing a lot of clients who are showing a lot of excitement around that sort of thing. So I don't know how much we'll see that coming out in the market. The other really big one is the the loss carryback provisions. That's the other really key one. Effectively, that will allow businesses to apply losses that they've incurred through this COVID period against profits in previous years to get some of the tax they've paid back. But the key point around that is that that's not going to come to fruition until people are lodging their tax returns for the 2021 year. And obviously that's still a fair way down the track. So unlikely that businesses will see a lot of relief from that as well. The other ones are sort of targeted at individuals. So, very welcome. I think the personal tax cuts are very popular in particular. That should help to stimulate the economy. But again, not a huge amount of direct support for businesses like we've seen in the past. All right, might get you to move again there, Andrew. And this is my last thing I wanted to talk about that's probably relevant, is that we had a call here at BDO and some of our other colleagues and other firms with one of the ATO officers who's been administering the JobKeeper scheme a few weeks ago, just to get a feel for what they're targeting in terms of their compliance activity, how likely it is that we're going to see businesses having to pay back wrongly claimed JobKeeper payments. Because as it says there, the ATO does have the power to compel employers to repay JobKeeper where it's been incorrectly claimed, but they also have the discretion not to do that. And certainly our experience to date has been that the ATO has been very reluctant to get employers to repay JobKeeper, even where they have seen errors have been made. And primarily they've seen those errors made in terms of the application of the rules, which were complex in nature and also were unclear, particularly early on in the piece. And they've found that most of the errors that they've seen have been as a result of an honest mistake. And the ATO gave an undertaking at the beginning of the JobKeeper scheme that where employers had tried to apply the rules in good faith but had made an error, that they wouldn't seek repayment, and that's been our experience. They've been good to their word. But moving into the second phase of JobKeeper, we anticipate, and the ATO confirmed it without saying it directly, that there will be more compliance activity in the second phase. And I believe, but without again knowing for sure, that the ATO is likely to be enforcing their right to compel employers to repay JobKeeper where it's been incorrectly claimed, much more in the second phase than they did in the first. Partially because it's now well established, there'll be fewer cases of employers claiming it, so they'll be able to do more compliance activity. And so I think in terms of the banking and finance industry, what will be interesting there is probably the two big things to take out of what I've spoken about here is, one is that a lot of the stimulus measures are coming to an end, and so I think that's going to cause some challenges for a lot of businesses. And secondly, I think we will start to see employers being compelled to repay JobKeeper. And obviously that's going to create some issues for employers who have claimed those payments and effectively pass them on to their employees. So yeah, a bit of uncertainty in terms of those things. So I think in that case, it's probably watch this space. But yeah, just a couple of things there to be aware of, I think. And on that note, I might pass back to you, Andrew. I'll stop rabbiting on.
Thanks, Will. Appreciate that. One of the other areas that have been provided through COVID-19 is protection to companies and individuals from creditors. And we've had a temporary protection from statutory demands, which until the 31st of December has been increased to a minimum debt of $20,000 over a 6-month period. And from the 1st of January, they'll revert back to the normal, which is $2,000 minimum debt with 21 days notice period. And the same for bankruptcy notices. So that's until the 31st of December, $20,000 with a 6-month notice period to repay. And from 1st of January back to $5,000 and 21 days. And Andrew Fielding, I think you would agree that these protections have really helped reduce the number of insolvencies.
They certainly have. I've always had a bit of a view, though, that I think there have been a large number of companies that have been protected by these provisions that would normally have gone into liquidation in any case. So, we've seen a substantial drop in the numbers. And I would foreshadow that there's probably 2,500 companies that would have been wound up in the normal course of business, excluding COVID, that haven't been wound up. A lot of directors, they're protecting themselves through the insolvent trading provisions or moratorium, and they're sitting back and receiving, even though the businesses may have actually closed, they're sitting back and receiving JobKeeper and various other subsidies from the government. So I think everybody keeps talking about this huge wave that's going to happen, and certainly the solicitors I've been talking to have a pile of statutory demands piled up on their desk ready to go 1 January. But I think we're going to see a lot of clean out of what we call zombie companies that have been sitting around and not wound up over the course of the year. And these are going to be companies probably with very few assets, because in most cases they've been dissipated. Because of the moratorium or the extension of the statutory demand period by 6 months means that there won't be too many preference payments that could be recoverable. So particularly in the case of the ATO, who normally is the greatest petitioner for winding up companies, they're going to struggle, I think, to find practitioners who are prepared to take on some of these jobs, because there's going to be no recovery, no assets, and therefore no ability to be paid by recoveries. So it's going to be an interesting situation. Everybody's talking about this tidal wave of insolvency that's coming, and I think we're going to see a very, very large spike. But most of these are going to be these zombie companies that should have been wound up. The rest of them are going to, I think we'll see spread out over the period. It may take another 6 months before we start seeing that wave of insolvency that everybody's expecting, because there still are a number of these subsidies, et cetera, that are keeping businesses afloat.
Andrew, so I'd make a comment that a lot of these creditors that are pursuing their debtors, to what extent do they need companies to what extent do they need to issue statutory demands or other forms of demands to activate their debtor insurance policies? So I think that, this is, no one sort of identified this as an issue, but I think it's worth being aware of. If you're a business which relies upon debtor insurance to protect your debtors, and yet you can't take action, what does that mean for whether you can call on your policy?
Yep. Okay, thank you, Andrew and Nick, for that point as well. Over the page, just going to briefly mention which protection that you're all no doubt aware of is that from the 25th of March until the 31st of December this year, the government has implemented in effect, a safe harbour, a defence for directors from insolvent trading. It's an automatic protection for all directors. It's not like you had to opt in or opt out of it. Debts for that insolvent trading protection needed to have been incurred in the ordinary course of business, except of course of cases of dishonesty and fraud. But of course the debts still remain due and payable. It doesn't mean that there's any debt forgiveness during this period. And that there's, as I said, the protections cease on the 31st of December this year, although I understand that the Treasurer has an ability to extend that further. Nick, I think the safe harbour, this temporary safe harbour has worked, but I think the interest is really going to be how the transition period after the 31st of December.
Yeah, and it's interesting, there's two professional bodies, the TMA and the RETA, that have taken different views on what directors ought to be doing if they form the view that their company might be insolvent. And whilst the RETA has said that you need to appoint an external administrator if you're going to obtain ongoing protection after 31 January, the TMA has a very different view that it's not required. I think that the federal government and the drafters of the legislation are having a look at this very issue because it's obviously critical. But I expect we're going to hear that directors will not have to put their companies into liquidation or administration if they want to rely on that protection after that date. Mind you, 1st of January, there's a new set of rules.
I think, Andrew, if I could also add to that, whilst this has been a protection for directors for insolvent trading, I think we're going to see an increase of in our clients looking for advice in respect of being sued for preferential payments. Because my personal view is that the government got it around the wrong way. The insolvent trading provisions were covered by safe harbour, but there's been no protection to those businesses that have gone out of their way to try to continue to trade with people who are struggling in a cash flow basis. If they subsequently fail in the next 6 months, then certainly all of the payments that have been made are potential recoveries for a liquidator. And I think that there should have been more protection for those people who have gone out of their way to accommodate repayment schedules, etc., etc. But it's going to be one of the defences for a preferential payment is no knowledge of insolvency, and I think that's going to be a very hard argument to run during the COVID period that you had no suspicion of insolvency. So it's going to be interesting to watch that space.
And this doesn't excuse directors who trade recklessly, and there's a distinction between trading whilst insolvent and being reckless. So I think there's an important distinction there.
Yeah.
Okay, thank you, gents. So let's move on into what's proposed for the new insolvency laws from the 1st of January. But Nick, we might just start by what actually is available at the moment. What are the options until the 31st of December, at least, for dealing with distressed businesses?
Sure. Okay, so they broadly fall into two buckets. There's the informal and the formal. And the informal, it's not new, but typically it's in and around how do you negotiate with a range of creditors? How do you introduce fresh equity? But it's got to be based on a plan. And I think that this theme of a plan is going to resonate during the course of this discussion. Andrew just touched on safe harbour, the COVID-19 safe harbour. And I think, Andrew Sallway, you're going to talk to safe harbour more broadly, but new legislation brought in 3 years ago, and it's about providing a safe harbour, protection, defence to insolvent trading for directors. And ultimately, I think we'll see a bit of this in the new year, that as businesses have exhausted their capital in just trying to survive lockdown and put their business into care and maintenance, to what extent do they have balance sheet or working capital capacity to restart? And if they don't have the capacity to restart, I think there'll be a number of businesses which look to sell as an exit strategy for the directors and shareholders. On the formal side, I think everyone has a level of awareness in and around voluntary administration and deed of company arrangement. And I think, Andrew, you're going to talk to the new insolvency laws shortly. Liquidation can be solvent, can be insolvent, often used to extract capital gains tax exemptions on the sale of assets, and the insolvency reforms, which, Andrew, I think you're going to talk to shortly.
Yep, no, I'm going to go to those right now. Thank you, Nick. The only point that I would just make, the exit by a sale of business, I can think of at least 3 very large voluntary administrations that, you know, our firm was lined up to do during this last 6 months or so, and ultimately the owners have sold the business for, you know, $1, $5, $10 million, on the view that a little bit of money now is better than potentially losing your business to an insolvency, you know, post-COVID. So let's talk about the small business insolvency reforms. It is the government's response to, you know, what we expect will be an increase in the number of insolvencies in the new year. And it's really an alternative to the one-size-fits-all voluntary administration regime, really targeted at helping small businesses. And it's, you would have heard perhaps in the news or in various emails and things about this concept of a debtor in possession model. Well, this is it. This is what we're going to talk about now, this debtor in possession model. In order to be eligible for the new regime, as I said, it's really for small businesses. The liabilities of the business need to be less than $1 million. So then we're not talking about big companies, we're talking about mum and dad businesses, we're talking about SMEs, particularly in circumstances where, you know, there are a number of businesses who have perhaps backed up tax liabilities, as Will mentioned, or backed up landlord liabilities. It could be that many small businesses actually exceed this $1 million threshold. Importantly, to qualify, you need to have all your employee entitlements paid. We're not talking about accrued leave and things like that, but we're referring to wages and superannuation. You need to have all of your tax lodgements up to date, not paid, but up to date. And the directors need to make the resolution at the time of entering into this regime that the company is insolvent or likely to become insolvent. I thought it might be easy to compare what everybody knows, which is the voluntary administration regime, which is on the left-hand side of your screen, with the new regime on the right-hand side. And I'll just go through the 5 or 6 main parts of a voluntary administration and compare that to the new regime. So importantly, during administration, everybody knows that the administrator controls the business on a day-to-day basis. That is not the case with the new regime. The director remains in control. This is the concept of debtor in possession model. So it's not the restructuring practitioner that runs it. The time frame for the new regime is 35 business days. It's split into 2 parts, 20 days to develop the plan, and then with 15 days notice, a report goes out to creditors for them to vote on the plan. The reporting is a little bit different. In a VA, you all know about the 439A report, which can be frequently, you know, 100 pages in size. Really, for the new regime, we're talking about certification of compliance for eligibility. So all the things I talked about on the previous slide. There's some discussion about outlining what the restructuring plan looks like and whether or not the plan is capable of being complied with. There isn't really anything that deals with investigations, reasons for failure, any offences committed. So very much focused on the debt restructuring plan, which is the mechanism for the new regime as opposed to the old deed of company arrangement. It's expected that because firstly, control remains with the director, and secondly, because the reporting required will be much less, that the process will cost less as well. So it'll be a cheaper process because voluntary administrations can be expensive for small businesses. As I mentioned, the liability for debts during the restructuring period, because the director remains in control, liabilities for the debts remains with the company. So there's no personal liability for the voluntary administrator. The voting has changed. The voting for the new regime is 50% in value of creditors that vote, which is very different to the typical insolvency regime that we're all accustomed to, where it's number and value. So it's just 50% in value of voting. I might make the point that there is no meeting of creditors. It's just filling in a slip of paper and returning it to the restructuring practitioner. And at the end result, so instead of you go into a docker or a liquidation at the end of the period, at the end of the 35 days, the debts are restructured, the plan is adopted, the business continues, or the company goes back to the directors. There's no automatic liquidation at the end of it. But importantly for the directors, they have already made the resolution at the start of this process that the company is insolvent. And all of these debts immediately become due and payable if the plan is not adopted. So there is some risk for the directors if the plan is not accepted by creditors, and they will need to have an alternative plan, which will be no doubt a liquidation.
Andrew,
Nick,
is there anything on related parties and how they can vote in the new regime?
Nick, related parties are excluded. They are not allowed to vote.
Yeah.
Not allowed to vote. Just gone over the page now, Nick. There isn't a template or a list of minimum requirements for what the debt restructuring plan should look like. And you've just listed here on the screen some of the things though that you think are important to include.
Yeah, well, I think that at the heart of this restructure, there has to be a plan. Now, there's the plan, I think, comes in two phases, really. There's the plan to restructure or compromise the creditors, but there's also the plan in and around what does the business need to do differently so it survives on the other side. There's no point in reconvening in 3 months' time when the plan hasn't worked. So what are the components of the debt restructuring plan, whether it's under the new rules or whether it's a restructuring plan more broadly? And I've just listed there the key stakeholders that I think are sort of, it's inevitable that the majority of these parties will be key considerations in putting together whatever the plan is. And to your point, Andrew, the restructuring practitioner ultimately has to sign off on the likelihood that the plan is achievable. So if you think about all the people that operate within the universe of an SME business, it's typically going to be employees, suppliers, certainly landlords, and to the extent they've got secured creditors, it's not going to be a big pool, given that the threshold's $1 million. But I think that we've listed there the key sort of 5 or 6 key parties that inevitably will need to be addressed and considered as part of the restructuring plan.
And importantly, just obviously it's a banking audience today, with reference to the secured creditor, the same as a deed of company arrangement. Secured creditors are not bound by the plan unless they vote for it. So that element of the deed of company arrangement rules for secured creditor is consistent in the debt restructuring plan as well. But you're right, Nick. I mean, the role of the restructuring practitioner is really just to, advise creditors if the plan, is likely being successful, and then really just to administer the plan, which is collecting in the money and paying out the dividends.
Andrew, I'm assuming that the administrator is also going to have to write the report. Who actually writes the report?
Yes, the restructuring practitioner, the appointed restructuring practitioner, writes the plan or writes the report that goes to creditors. Yeah, but it's not a big report. It'll really just outline the plan and the future for the business. Yeah. Okay, so I mean, Andrew, these plans, I mean, once they start to get implemented next year, you know, no doubt it'll raise lots of questions and there'll be holes and things. But based on what we know so far, what do you think will be the main challenges for the companies and their stakeholders with these plans?
Well, Andrew, I think whilst it's not on the list there, I think you've raised one of the very important challenges, particularly for creditors, is the process of the meeting, where you're saying that it only needs a 50% majority of those parties voting. Now, you know, after being in the business for 30-something years, I can tell you it's very hard to get anybody to respond at all, if not within time. So if you're sending out a circular to creditors asking them to vote on something, they've got 15 days to get around and do something about it. I think we'll find a lot of creditors potentially bound by these agreements who had no knowledge whatsoever of what was going on, because you know, you may only have to get 3 creditors respond and 2 out of those 3 vote for it, and all of a sudden everybody's bound by this. So that's going to be an interesting challenge. But overall, I think, you know, standing back and looking at this on a commercial basis, the biggest issues that I see is the credibility of the people who are going to be in charge of the business moving forward. You know, whilst I'm not suggesting that every director out there has done the wrong thing or is incompetent, but one of the first questions that that I get asked when we take over as a voluntary administrator is, who's in charge of the business? Who's going to be continuing to run on a day-to-day basis? Creditors automatically are hesitant to continue to deal with someone who has got themselves into an insolvent position. Now, in this situation, I appreciate this has been introduced to deal with COVID, which is not, you know, it's a very unusual situation. The closure of whole cities and states, etc., has, you know, brought an artificial downturn in revenue, but it's still going to be very hard for the creditors to accept that they're going to continue to trade with the particular director who was in control of the business. The next point there is the plan. I mean, you've stated that the administrator needs to assess how achievable the plan is. Now, the whole purpose of this regime is minimal cost. Now, once again, from experience, very few businesses, particularly businesses with less than $1 million worth of creditors, have got any sort of cash flow, P&L forecast or anything like that. And so I just don't see how, you know, an administrator who is going to be a registered liquidator is going to be able to sign off without spending considerable time assisting with a cash flow and a P&L and trying to test the assumptions behind the cash flow. So I just don't, you know, I question that. The other part of it is, moving on, is the uncertainty. Most times we're able to retain the employees, for example, to continue to work on the basis that they see some future. But in this situation, I think you'll find it'll be very hard to have your employees continue. Creditors and customers are going to be the same thing. If you're selling something, you know, like a can of Coke, then I see it work. But if you're a builder or an engineer, or you're a fabricator, or something that has a time delay in the supply of the product, I can't see customers wanting to continue to trade with you. If you're a head contractor and you're waiting for an air conditioning plant to be, or, you know, even ducting to be fabricated, you're not going to sit there in that situation and be potentially 6 weeks behind when this fails and they're unable to provide the goods. So it really does only apply to someone who's selling a product. Credit is going to be an issue. I mean, what supplier is going to go, yeah, that's fine, you've just told me you're insolvent and I'll continue to provide goods on credit. So I think you'll find that most people will then automatically be looking for COD, which is going to be a complete drain on cash flow, particularly if all the employee entitlements need to be brought up to date prior to entering into this. So I just don't see where that's going. The other one, which is something which seems to be raising its head quite regularly at the moment, are bank chargebacks. The whole COVID issue, I think, has highlighted the issues with these, with a number of financiers being in trouble with large degrees of chargebacks on credit cards, where they felt that they didn't really have a large exposure to a particular business, and all of a sudden there's been a lot of cancelled deposits, etc., and the liability there for chargebacks. So once again, if you're a bank and you're advised that your client is insolvent, are you going to continue to provide credit card and EFTPOS facilities to that client with the exposure for the potential chargebacks? Trading terms and credit terms, I think that once again that's going to be something that's going to be looked at very closely. And retention of title, you know, I've already had a session with my partner group here who are talking to our clients, talking about having to get closer to your clients, to their customers, because under the legislation you're restrained from recovering goods which are subject to retention of title. So I think you'll find that there'll be a lot more people who are going to be trigger happy, and as soon as they start to see some form of financial stress, may just immediately go and retake their goods prior to the company putting its hand up and saying we're entering into this regime. The legislation, I don't think, Andrew, really deals with who becomes liable for those retention of title products that are sold during the period, which is a real anomaly. Under the current legislation, if we as voluntary administrators sell product that is subject to a retention of title during the voluntary administration period, we're personally liable for it. So if there's a moratorium on the directors, are they able to just have a free-for-all and sell all these products which are subject to a retention of title? Do they need to quarantine those funds? There's just a bit of uncertainty there. So, you know, and there's a bit of uncertainty, as you've stated here, trading trusts, not clear directive as to how that's going to work. So it's almost like the safe harbour legislation. It's taken a long time for it to get any traction because people have really struggled to work out how to use it. And I think there's going to be, it'll be interesting to watch this space to see how successful this legislation really is, because I just see a lot of impediments for it to get traction. That's all.
Yeah. Okay. Thank you for that, Andrew. And I think we need to be honest with what it is. It's called a debt restructuring plan, but there's no restructuring. There's no operational change. It's a debt plan, and it's a plan to convert liabilities from full value down to cents in the dollar. It's a cram down on debt. But we'll see, as you say, Andrew, we'll see how successful it will be.
But Andrew, the government has continuously, suggested that it was a Chapter 11 regime. Now, Chapter 11 regime in America is an extremely court-driven process. You know, it's an expensive process. People don't jump into it easily because it's such an expensive process. And this is a long way from being a Chapter 11 substitute.
Miles, I agree 100%. It's miles away. It's just telling all your creditors you're going to pay them 10 cents in the dollar over 3 years. That's what this is. Let's move away from the new legislation that's coming in. Let's now talk about some of the learnings that we've had from our key stakeholder groups. And Nick, I might just start with you, if you wouldn't mind, talking about how landlords have been impacted by COVID-19 and what the future holds as a stakeholder.
Yeah, landlords are interesting. I think they're the only stakeholder group during COVID that hasn't had government support, and yet it's been enforced upon them that they must provide support in differing guises to their various tenants. What I think is particularly interesting is the landlords have been forced to provide concessions, whether it's rent abatement or whether it's rent deferrals. But what that means, of course, is as businesses restart, they've got to deal with this deferral. Now, whether it's a deferral for landlords or others, what's particularly interesting, I think, with landlords is, and the large institutional landlords in particular, there was a rush initially to settle up or provide some sort of alternate rental arrangements with their tenants to ensure that the tenants were going to survive. And that's even before the Code of Conduct was introduced. But as we exit from COVID and we exit from this Code of Conduct, what's particularly interesting is the landlords that have provided concessions, or more accurately, tenants who've taken concessions in excess of what the code provides, the landlords have an expectation that these tenants are going to be making catch-up payments. So the tenants will be making catch-up payments not just on the deferrals, but potentially the overclaims of either abatements or deferrals. So there's going to be some challenges for some businesses on how they meet that deferral and catch-up payment. Going back in time, landlords were starting to think about what was your pre-COVID health, what's been the impact of COVID, how proactive have you been in and around obtaining concessions, and what have you done to right-size your business. Now it's all about what your recovery trajectory is. And whilst the landlords have provided concessions that have been enforced, ultimately the relationship between a landlord and tenant is a bit like a marriage. It can be a happy, loving marriage, or in many cases it's an enforced arrangement. And so, there's lots of discussion in and around what do tenancies look like, particularly in the office space. But I think that the landlords are getting smarter. The landlords have realised that there's a lot that they can learn from the banking sector. The banks understand credit. Landlords don't. Landlords typically would grant a lease based upon an audited set of accounts, maybe a Dun & Bradstreet check, and a bank guarantee for a month or 3 or 6 or 12. Well, landlords have realised that they're well behind the understanding of credit and what they need. They can learn a lot from the banks, and I think that the landlords are going to change their thinking because they have to.
Okay, thank you, Nick. Thanks for that. Now, what about how lenders have been impacted? Andrew, what are your reflections on financiers and the impact on COVID-19?
Well, the interesting thing, it's with financiers, we're seeing a fairly broad spectrum of how they've responded, and I really think it's subject to the size of the financier. We've seen a fantastic response by the Big Four and the larger facilities supporting their various customers. Although the message that has come through is that it can't go on forever. They certainly will continue to support where they can, but I think there will be a line drawn very soon as to how much additional funding they're prepared to provide. The smaller banks and smaller financiers, I think we're going to start to see a bit of activity because they don't have the balance sheets to be able to support the ongoing deferrals of interest and the unwinding of all of these arrangements that have been put in place. Everybody's aware that APRA released a couple of weeks ago the directive that for a loan not to be deemed to be impaired, it has to be documented, renegotiated and documented by the 31st of March. So that's going to be a massive task for everybody involved, and certainly the smaller operators are going to really struggle to get that in place. But failing that, it's still going to be a case that every financier is an annuity business. They need interest to be paid to pay their bills. So the smaller financiers, the smaller banks, like the state-based banks, will struggle to be able to continue to offer those capital interest deferrals because their balance sheet is not strong enough to carry it forward. I think the interesting thing for financiers, and probably more importantly for borrowers though, is we're still seeing a large number of businesses that really have no plan moving forward. So we're starting to get a bit of inquiry and a bit of referral from the various financiers to go and have a look at their customers to determine the ongoing viability. Everybody simply puts their hand up and says, oh, we don't know what the future holds because of COVID, but they still need to have some plan in place to give them some comfort. So it's been a really tough time for lenders. I think that if you put the fact that COVID followed the Royal Commission, has really put them in the hot seat in that they've tried to recover some of the goodwill, and I think they have done a fantastic job at recovering that goodwill, and they certainly don't want to lose the goodwill that they've created. But borrowers should be aware that there will be a line that they won't be able to cross, and the funding will stop. So that's where I see it, Andrew.
Yeah,
Andrew,
the banks have been very good. Yes, Nick?
I was going to say, we ran a survey perhaps 2 months ago across a number of accountants and asked them, this is accountants in public practice, and asked them for their feedback on some of the themes of their own client bases. And so ultimately our survey sample was about 20,000 businesses. And to Andrew Fielding's point, less than 80% had a plan to navigate their way through COVID and out the other side. That was a really interesting statistic. And I think another really interesting statistic was in excess of 25% of these businesses expect that they'll need additional help from bank, tax office suppliers when JobKeeper rolls off. And another interesting statistic was another 25% expect that when JobKeeper rolls off, that they won't be able to obtain the additional support from banks, suppliers and the like, and expect to be under a level of pressure from their lender for those sorts of issues. So it's interesting, there's an expectation of businesses in this SME space that they're going to have some challenges in dealing with their banks and their suppliers, their key stakeholders, their landlords, in funding whatever this restart might look like for their business.
Yeah, thanks, Nick. That's a really good point. And I mean, Will, you're still on the line, maybe come off on mute, but you know, a lot of these types of businesses are your clients. Would you broadly agree with Nick's assessment that, you know, businesses really aren't, or that not Nick's assessment, but Nick's survey that showed that really a lot of businesses aren't planning post December?
Yeah, thanks, Andrew. The first thing I'd say is obviously our clients are particularly well advised, and so they have been planning obviously right from the very beginning. And in fact, a little bit tongue in cheek there, but I think you know, Andrew, we've done a number of these now where we have been talking to clients right from the beginning, you know, for cash flow forecast, 90-day cash flow forecast all the way through. But so look, I know I would agree with Nick, and I think that was sort of the tenet of what I was saying as well, is that a lot of these things are sort of, they really have carried businesses through this period, and, you know, just alleviated a lot of cash flow pressure, have allowed them to push a lot of difficult decisions down the road a little bit. And I agree, I think there's a lot of apprehension there around how the end of these, you know, stimulus and support measures will affect businesses. The other thing I'd say is that we've possibly been anticipating, you know, a little bit of a slowdown for some months now. We keep thinking that keep talking to clients and saying, keep an eye on your debtors. You know, that'll be the first thing, that'll be the first sign you'll see that that'll be the canary in the cage that you know, there might be some trouble coming, and we haven't sort of seen it yet. But I agree with Nick. I think we're treading carefully through the next few months for sure.
Yeah, thanks, Will. And your point about debtors is a good segue, Nick, to you to talk about suppliers and, you know, they're potentially you know, big fallout for them out of all of this.
Yeah, and it's interesting, depending upon whether we're acting for a creditor or for a debtor, you obviously take a different view. But I think that working capital is going to be really more important than ever over the next few months as businesses, particularly the affected businesses or the more aggressively affected businesses, have to restart. And so to what extent have businesses invested in enhancing their own credit systems and protocols, which includes obviously how do they best manage their stock and debtors? And we know that there's a lot of businesses out there that don't really understand the concept of retention of title, let alone how to utilise the PPS and the PPS register to enhance that that retention of title issue. So ultimately, to what extent do businesses have a credit system, a credit protocol, a PPS protocol? To what extent do they understand what securities they actually hold? Because it's only now in the time of a crisis that you have the opportunity to test just how good your insurance policies are, and of course your PPS securities which you hold as opposed to securities registered against you. This is a true test of how good your systems are. So the stronger businesses, those that have invested in building and developing a PPS register, a PPS system, a credit process, they're at one end of the spectrum, and those that haven't thought about this are going to be tested, because as the statutory demand changes, as credit becomes more of an issue, those that haven't invested are going to have some challenges, and they're the ones who are going to be asking for their facilities to be extended or deferred.
Very good, thank you, Nick. Yeah, I agree 100%. I think there's a lot of suppliers, and of course the bankers and financiers on the line. Of course, these are customers of the banks as well, and it might come as a shock to a lot of people that suppliers just aren't across these issues, even though it's their bread and butter. Just conscious of time, and we might move on to the final section, which is what strategies we think will be successful strategies will be in place for next year. Andrew, I might hand over to you just to wrap up with these final thoughts.
You're on mute, Andrew.
Sorry, thanks, Andrew. It's the same old story that we've been saying all the way through COVID. Planning, engagement, engaging with stakeholders. So we've been saying to our clients and the people that we've been engaged with, do you have a cash flow? Have you put a plan in place? What does it look like when you don't have these subsidies? And the unfortunate thing is a lot of people continuously respond and say, we just don't know what it looks like. And so we say to them, okay, we'll put a cash flow or a projection together based on a number of scenarios. Put it together on an Excel spreadsheet so that it's not hard coded. And you can say, okay, if it takes 6 months or 12 months or 18 months or 24 months to get back to your original revenue line, what does that look like? What is the worst case scenario? At least show that you've put some thought to it and you've got some plan. And then you really do need to engage with your key stakeholders, the banks, suppliers, customers, employees. As I said, particularly, the banks need to know they're treading very, very carefully at the moment. They've got huge resources being put in play to manage COVID-assisted loans, et cetera, but I was speaking to one of the people in charge of credit for a business bank just recently, and he said that they're ringing customers, but as this has progressed, they're getting less than 50% of customers are actually taking the calls or returning the calls. They're trying to hide. They're just not engaging now that we've got further down the line. So they really need to engage. Customers, they need to be engaging with their customers to assure that they have the ongoing support of their suppliers, that they are able to meet the obligations, particularly if you're, as I said, if you're not selling Coke cans over a counter, you need to make sure that your customers know that in 6 months or 12 months or whatever, you're able to make provide the goods that you're providing. Talk to your employees. They're, one of the things that's been really important here is to give employees some confidence that they've got an ongoing job. And then, you've got your unions, your landlords, the ATO, everybody, everybody needs to be engaged. And the more you talk with people, the more support you will get. But also you do need to bring in an advisor, which is really hard at the moment. If you are cash strapped and you're trying to pay your wages and you're trying to pay your suppliers, et cetera, it's very hard. And, we're experiencing it at the moment where a number of people have approached us to assist them at the request of their banks or their suppliers or their customers even. And they're really conscious of how much that's going to cost. And unfortunately, time is money, and it does take a bit of time to understand the assumptions, et cetera. So what we actually have found is a lot of the banks are making provisions for providing funding for some initial advice from a restructuring advisor. So that's always something that they should be looking at. But just going back to the fundamentals, Andrew, as usual, which is, have a plan, test the assumptions, make sure you document the assumptions, and engage with all of your key stakeholders to make sure that they understand where you're going, what your limitations are, and moving forward.
Yeah, thanks, Andrew. And it's a bit corny, the fifth point there to say, intervention with the help of an advisor. But of course, I think the advisor really just brings credibility to the process and the plan and some robustness, which is very important.
It's an independent. I mean, one of the banks that I'm dealing with at the moment, the wife of the director is an accountant, and she goes, I know what I'm doing, and I don't understand why we're being asked to talk to you. And I said, look, it's just simply an independent, fresh set of eyes to give the financier some assurance that the numbers are right. That's all.
Yeah. Okay. That brings us on to questions. We've got maybe just a minute or two. There have been a few questions come through. There was a question, do you think suppliers may seek to take GSAs to protect against new small business restructuring rules? Certainly from my perspective, I am aware that suppliers are taking GSAs, albeit they're often second or third ranking to other financiers, but certainly I do think that will be the case. Don't know if anyone else wants to chime in on that one. And there was another question about, in terms of the new insolvency laws, what else might have been done? What could have been done differently? Again, from my perspective, I would say something that could have been done would be obviously to increase the threshold from $1 million. I think something closer to $3 or $5 million would be more appropriate. And probably that's what will happen in the long term, I would expect. Did any of the panelists want to comment about either the suppliers taking GSAs or new laws, what might have been done differently?
I just want to reinforce, I think that the smarter suppliers are going to be taking GSAs, and it comes back to the quality of the credit protocols that a lot of businesses who supply goods on credit are going to embrace. And they're going to need to do that to comply with their own internal systems. They're going to need to do that if they're going to comply with the terms of any debtor insurance policies that they might have. If there's an invoice discounting facility, you presume that it's a term of that they must be taking securities to ensure that if the secured creditor wants to step in, that they're in the best position possible. So, yeah, I think there's an inevitability about that, Andrew.
Yeah. Andrew, I think you're right on the money that I think the threshold should have been increased, but I still believe that there should have been a bit of a variation, a bit more variation to the VA process. I think there needs to be a bit more formality about it for it to be successful. A lot of the costs that we run up is protecting our ass. I mean, the reality is if we're trading and we're personally liable, we walk into a business and next week's got $200,000 of wages, we start to sweat. And the fact that they've turned around and said to directors, oh, well, you can continue to trade, but you won't be liable. So I just think that they're probably a bit more of a compromise, maybe a less reporting. I mean, we're obligated in the VA report to review the history of the company and assess the financials and do a whole lot of investigation. And I think there may have been a compromised version of the VA with a little bit more formality to give creditors some comfort, to give it, some greater success. That's what I think needs to happen.
Yeah.
My overarching concern would be if a director puts together a plan and a restructuring advisor says, I don't think this plan works, what's the obligation on the director at that stage? He can just keep opinion shopping until he finds someone who says yes. And so I think, to me, that's a real shortcoming here. There's no obligation on the director to accept the advice or the opinion of the restructuring advisor. And so I think there's a real risk of opinion shopping for a director who just seeks an answer that suits him as opposed to what the plan ought be.
Yep, that's a good point as well. Guys, we're out of time, and I'm just conscious that it's probably time to let people get on with their day jobs. So thank you to Will, Nick and Andrew today for participating. Thanks to everybody who joined us today on the webinar. Our next session will be on the 9th of December, and you would have seen an email inviting you to register for that as well. And will be on the assessment of solvency and the impact on financier actions and decisions. It'll be at 10 a.m. New South Wales Victoria time, at 9 a.m. Queensland time. Thanks again, everybody, for your attendance today. It's been great to have you, and thanks to the gentleman on the screen for helping us as well. And I hope you all have a good day. Speak to you next time.
Thanks, Andrew.
Thank you.